5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Monday morning. Cutting an unprecedented deal. Nvidia and AMD will pay 15% of their China AI chip sales to the U.S. government. Awaiting Trump-Putin talks, oil extends a decline ahead of a meeting between the U.S. and Russia on Friday. And gold futures slide. Traders wait for the White House to clarify last week's surprise tariff on bullion bars. We are basically at this moment a rounding error away from an all-time high. We closed on Friday 0.01%, actually less than that, but you round up to that, away from an all-time high. So even if we open up basically unchanged, we will get there. We are unchanged for this market to start with S&P and NASDAQ futures. Citi, though, they've boosted their year-end target for the S&P at 6,600 now from 63. The latest Bank of America survey says that investors are the most bullish in a few years. So we are getting that bullish sentiment seeping into the market. Now, for this bond market, and maybe for everything, the main show is tomorrow, is Tuesday. It is the CPI release. We had some bonds under pressure last week. They were higher by 6.5 basis points for your 10-year yield. Today, we're lower by about 3 basis points. 4.2539 is where we stand. And you can see Brent crude, that continues to fall down about 0.5% ahead of those Alaska talks between Putin and Trump on Friday. Let's get you some stocks moving underneath the surface now. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with Nvidia and AMD after news that they have agreed to pay the U.S. government 15% of their revenues from their China chip sales. We're seeing both of them on a back foot this morning. Nvidia down over 1%, AMD down nearly 2.5%. Now, both of these companies have failed recently to give any guidance on what that kind of China revenue would be. So when it comes to how much money the U.S. government could make on this revenue sharing deal, that still remains a big question. Let's keep in the AI space and move on to some more soft news there. We have C3 AI. This is an enterprise software firm that helps companies optimize anything from supply chains to their inventory, falling nearly 30% in pre-market trade after what analysts call was a catastrophic round of results, slashing their revenue guidance by a third, coming in way less than the market expected. Lastly, M&A Monday, as reported by the Wall Street Journal, we could see some M&A, some merger activity in the local TV broadcasting space. Tegna has become a takeover target of this competitor Nexstar, who is the biggest local TV news station broadcaster in the U.S. Now, Tegna has been the eye of some takeover interest before, but those deals have fallen apart due to regulation hurdles. Danny, this could be a new test, though, for Trump's new leadership at the FCC if they approve this type of merger. Danny.
Valerie, thank you very much for the roundup. We'll catch up with you later in the hour. Also, in this hour, in just moments, we'll be speaking with Ella Hoxha of Newton Investment Management on risk asset euphoria. Later this hour, we'll discuss the Fed's rate path ahead and CPI tomorrow with Saidel-Baker of ITR Economics. Now, Ella Hoxha of Newton Investment Management makes the case for staying cautious, writing, quote, current complacency in markets is likely to be tested in the second half, starting with core bonds and interest rate expectations. That may have ramifications for riskier assets such as equities and credit. I'm pleased to say that Ella joins us now. She is head of fixed income at Newton. Ella, always a joy to see you. And look, it is a strange time we're living in, that bonds can be pricing in a near 90% certainty that we're going to get a cut in the next meeting for fears of this labor market, with risk assets at all-time highs and credit spreads at new tights. What do you think is driving that complacency?
I mean, the data has been supportive, minus the last NFP print, which we can debate and discuss whether that's, totally reliable. And that's on the basis that a lot of what's been driving labor markets over the last 2 to 3 years has been demand for labor exceeding supply. And I think that's a little unusual as far as labor market dynamics go. So you could argue the fact that you're now having negative net migration in the US could be pushing the numbers lower. So it doesn't necessarily have to be a bad NFP print on itself. So even if you take that aside, data has generally been okay and supportive in the US. Markets obviously went through this massive fear phase back in the spring spring. And so now the pressure point has been upwards. And so we've broken key technical levels, whether that's on the MAC 7s or just more broadly in equity indices. And so the euphoria is in play. And I actually, we talk about euphoria, but the Bank of America Fund Manager Survey, which hit my desk this morning, was talking about the most bullish we've been since February 2025. So the market's low cash levels as far as active managers go, and basically pretty bulled up.
You say that your concern, as I mentioned, Ella, starts with core bonds. I mean, we did see some pretty tepid bond sales last week. How much of that is due to just lower yields following those weak NFPs versus some real stress there, be it concerns about Fed independence, a ballooning deficit? What do you see driving weaker sales, and does that continue on? Is that part of your call?
Well, we're trading flat to or below cash. So the value proposition is not there in lots of ways. That's number one. So to your point of, is the yield too low for investors to come in? I think the answer is yes. The second part that concerns us, and that's what's caused us to reduce interest rate sensitivity at the portfolio level, is basically this tick up in inflation expectations, which is not consistent with the level of price cuts we have in the curve now. So what the market's been pricing. And so actually we think the coming quarter or two, we will start to see a tick up in inflation. Nothing dramatic, I don't want to overplay it, but enough to cause a bit of a head scratcher for the Fed. And so with that in mind, we're becoming much more neutral on our duration sensitivity. And if that's confirmed, we probably expect to reduce further.
Could that happen tomorrow? And what's the vulnerability of this bond market if CPI does appear to be stickier in tomorrow's report than expected?
Yeah, I'm not a big fan of forecasting, to be honest. I make a point of that, and not because we cannot have a view. It's because I think it's a bit of a pointless exercise. You can have your models, which, it's more about the asymmetry and where the risks lie. Are the risks to the upside or downside? I mean, markets are obviously priced for a bit of perfection now, as we say. So what would concern us at the portfolio level is if things start to tick up. Why? Because I can only see that as really the higher probability risk that can disrupt this risk-on mood that we're seeing in markets. And that's why that's the sort of the tail risk, if you like, that we'd like to hedge.
And the other thing that maybe Ella's been supporting this market has been earnings, that while uneven overall on a headline basis, they look strong. But then we get this reporting overnight from the Wall Street Journal, we have it as well, that AMD and Nvidia might be giving 15% of their profits on their most advanced AI chips that they sell to China to the U.S. Ella, I mean, that's a completely different dynamic for companies to try to deal with. We can talk about the political ramifications, but just in general, it does mean slimmer profits. How do you think about that? And as we evolve, dealing with tariffs and, again, extra added political dynamics for companies to try to navigate right now?
Well, I have lots of empathy for the CEOs of those companies, right? Because they do have to navigate this terrain, but it is part of this new regime. We've talked about this. It's a much shorter cycles, more volatile regime. So as an investor, you should demand more risk premium, but that's not the case, right? When we look at the PE multiples for those companies, they're very high. So a lot of the good prices are baked in. So, you could, if you want to take a contrarian stance and say, well, maybe all the good news are in, but how do you deal with that? I mean, I guess through, as a portfolio manager, you deal through portfolio construction, right? So the sizing of the bets and probably staying away from extreme cases or extreme views. Those are potentially blind spots that can open problems in the future. It's very difficult to predict the geopolitical angle, other than to say we've shifted in a regime that's far more, domestic, local, and where the government keeps on playing a very big role.
It's impossible to avoid the conversation of politics, be it for corporates or for this bond market. Ella, I just want to end here because before the weekend, there was also reporting from the Wall Street Journal that two new figures have emerged in the Fed chair sweepstakes. That is Jim Bullard and Mark Summerlin. That adds to the Kevins and Waller as a potential candidate. Bullard, though, and Summerlin, much more traditional type candidates. Does that take some of the risk premium out of this bond market, the fact we could get someone along the likes of those two figures to lead the Fed?
Yes, absolutely. More traditional, the better for the market. As an investor, as a cynic, I take a step back and I say, is this Fed going to be more hawkish or dovish going forward? What is the preference for the guy or girl? I suppose maybe if there will be a girl up for the job too. That's going to take this role on. And then the answer is quite simple. I think more likely to be a more dovish Fed. And so with that in mind, your expectations of term premium go up, not down. And I think we're only like halfway through baking that term premium into bond markets when we look at the longer term history of yield curves. And so with that in mind, I would still stir on the side of caution.
Yeah, to the point of a woman being the next Fed chief, Mickey Bowman out over the weekend talking about 3 cuts this year. So maybe she is indeed trying to get that nomination. Ella, thank you so much for joining us. It's great to see you as always. Ella Hoxha of Newton Investment Management. Let's look at some other top stories now that are trending on the terminal this morning. Lithium prices and stocks spiked earlier today after Chinese battery giant CATL suspended activity at a major lithium mine in China. The company said it will resume production after its license is renewed and that there would be no material impact on operations. PIMCO CEO Manny Roman signaling caution over private markets. The chief of the $2.1 trillion bond market giant warned that private markets haven't been tested by a steep economic downturn. He was speaking with the FT and further urged on the need to constantly think about what can go wrong. And Bitcoin has risen to within striking distance of an all-time high. Demand from institutional investors and corporate treasury buyers lifted the wider market for digital assets. The gains come off the back of mounting interest in crypto among large investors. Digital asset treasury companies have built a stockpile of Bitcoin worth $113 billion. Coming up, we get back to that top story. Nvidia and AMD agreeing to pay the U.S. government 15% of their advanced AI chip sales to China. More on that unprecedented move. That's coming up next on your brief.
You know, the world is reconfiguring itself, and we are a company, and we have to adapt to whatever the world's trade and tax and tariff conditions are. And so this is something we all have to adapt to. But the very incredible thing is, Nvidia is a very adaptable company. Our supply chain will have to adapt, and we will find a new way.
And adapt they have. That was the Nvidia CEO Jensen Huang speaking last month about navigating the changing trade environment. Well, how about this for navigating? U.S. chip makers AMD and Nvidia, they're under pressure now, and they have agreed to pay the U.S. government 15% of their revenue from Chinese chip sales, according to our reporting, part of a deal that would help secure an export license. Joining us for more on this on trade is Bloomberg's Lauren Dezensky, who helps lead our breaking news coverage out of D.C. Lauren, people have looked at this deal and said, OK, are we tariffing exports now? What exactly are the details of what we understand to what's happening with AMD and Nvidia?
So one thing you'll hear more than anything is that this is unprecedented. For U.S. companies to be paying 15% of revenue for these specific chip sales to China, again, is unprecedented. Really, we've seen Jensen Huang of Nvidia, as well as other chip companies, pushing the U.S. government to really do whatever they can to unlock the Chinese market as well as others. And I think, again, back to the unprecedented point, it goes to show that this Trump administration is really interested in kind of doing whatever it can to not only unlock unexpected sectors, but to also extract what they want from companies. They're extracting concessions. It's estimated that this 15% out of Nvidia at least could generate roughly $1 billion a year. That would obviously go into U.S. treasuries, or into U.S. reserves, rather. And the idea that this administration is looking at other ways of working with these companies and even just seeing how these companies have to adapt to this administration. I mean, look no further than the president's Truth Social feed and how he interacts with various CEOs, such as the Intel CEO who is coming into the White House today. This is an entirely different landscape. And so it's clear that these CEOs, as well as this administration, are just thinking differently in terms of how they have to navigate this current environment.
Lauren, it's such a good point that it's not just pressure on countries, it's turning to pressures on companies, which, by the way, Previously, this wasn't going through because of security concerns, which raises the question, okay, are those gone? But the countries still are under pressure, Lauren. Tomorrow we get the deadline for getting a China trade deal done. Do we seem any closer to at least an extension?
It sounds like it will be another 90 days. Again, we don't know until Trump himself says it or posts it on Truth Social. However, the Trump administration, officials like Howard Lutnick, Commerce Secretary, have indicated that the expected 90-day truce will come to fruition. The deadline is tomorrow, Tuesday, so we will have to see. This is another classic example of we don't know the decision until Trump himself says it or posts it. We do know after the talks in Stockholm between the U.S. and China negotiators that 90-day deal was indicated or did appear that was going to be what the agreement was. That's what the Chinese side said. And then the U.S. side said, whoa, wait, we'll have to see what Trump says. So, again, we are still here waiting for what the president actually has to say.
Yep, it's a lot of waiting this year. Lauren, thank you so much for joining us this morning. Excellent reporting. That is Lauren Dezensky in D.C. Now, from China to Russia, President Trump and Vladimir Putin are planning to meet in Alaska on Friday, discussing the war in Ukraine. At the moment, talks don't appear to include President Zelensky. Here is NATO Secretary Mark Rutte ahead of the big meeting.
I think it is important that the meeting takes place next Friday. President Trump broke the deadlock with Putin in February. That was very important. Only a couple of weeks ago, he decided to, again, open the floodgates of lethal support into Ukraine and to put secondary sanctions on countries like India. So he clearly is putting pressure on Putin. Next Friday will be important because it will be about testing Putin, how serious he is on bringing this terrible war to an end.
We're also seeing oil declining this morning, about 0.5%, as investors gauge peace in Ukraine. And 0.2%. That decline has lessened. Really gauging what this might mean for crude supply. Pleased to say that I'm joined by Bloomberg's Tony Halpin, who leads our Russia coverage. Tony, what are the expectations for this Friday in Alaska?
Well, that depends on who you are. Europeans and Ukraine are pretty alarmed by the prospects of Friday's meeting because they're not at the table. And what they're really worried about is that President Trump and President Putin will cut a deal together that allows Putin to hold on to Ukrainian territory and that they'll have very little say in this deal. Trump, as you've noted in the piece, is keen to test Putin's sincerity on reaching a ceasefire. So far, he's resisted all efforts and all calls from the US for a truce. And Putin, of course, is very keen to lock in his gains and may be willing to see whether Trump is going to give it to him in return for an agreement on a ceasefire.
Part of what Trump has talked about is some swapping of territories, in his word. Tony, is that a non-starter with Zelensky, with Europe?
Well, we have to remember that when you talk about swapping of territories, that this is all Ukrainian territory to begin with, and that Russia is illegally occupying it. So from the Ukrainian perspective, this is a non-starter simply because, as President Zelensky said, he's not in a position to cede territory, and the Ukrainian constitution doesn't let him do so. But the fact of the matter is that Russia holds on to this territory, it occupies it, and I think neither Europe nor Ukraine currently believes that they can reclaim that territory. So there's going to be a lot of subtle wordplay, I think, around the idea of Russia holding on to territory while Ukraine and Europe don't recognize its possession of that territory. But we will have to see what form of words comes out on Friday.
Well, Tony, so far, prior to these talks, it seemed like a Trump administration that wanted to put economic pressure on Russia, targeting countries like India for their purchasing of Russian oil. Is there a risk that this changes the outcome of that this softens Trump having a one-on-one meeting with President Putin?
Well, let's not forget that the deadline for Putin to agree to a truce was, in fact, on Friday, and that deadline came and went, and there wasn't a general application of secondary tariffs on countries that purchase Russian oil. There was one placed on India, but China is the biggest purchaser. Nothing has happened there. Turkey is another major purchaser. Nothing has happened there. So it's been quite selective up until now, and I think we probably won't see much action until Trump and Putin get together on Friday and they can test each other's sincerity in reaching a deal. If a deal is reached, then I suspect that we'll no longer hear much about secondary sanctions.
Fair enough. Tony, thank you so much for joining us this morning and that update. That is Tony Halpin. Coming up, the Intel CEO is meeting with President Trump. That, according to the Wall Street Journal. We're going to have that and the other headlines in the front pages of your papers this morning. Stay with us on your Bloomberg Brief. You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning, what's making headlines in the major publications. First up, in the Washington Post, the FBI is dispatching agents to Washington, D.C. to tackle increased carjackings and crimes. This comes after President Trump recently threatened to call up the National Guard. Trump will be holding a news conference at 10 a.m. Eastern to address the situation. Next up, Al Jazeera is condemning the killing of one of its journalists by Israeli forces in Gaza. Prominent Al Jazeera journalist Anas al-Sharif has been killed, along with 4 colleagues, in an Israeli airstrike on a tent near Shifa Hospital in eastern Gaza City. Israel's military said it targeted Anas, alleging that he headed a Hamas cell and was involved in rocket attacks against Israel. And on the Wall Street Journal, Intel CEO Lip Bhutan singled out by President Trump to visit the White House. This after the president recently called for his removal over ties to business in China. Sources say that the CEO hopes to show his commitment to the U.S. Coming up next, it is a market awaiting CPI. What will the inflationary report mean for the Fed at their next meeting? Lauren Saidel-Baker of ITR Economics will be joining us next on Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Monday. Cutting an unprecedented deal. Nvidia and AMD will pay 15% of their China AI chip sales to the U.S. government. Awaiting Trump-Putin talks, oil extends a decline ahead of a meeting between the U.S. and Russia on Friday. And gold futures slide. Traders wait for the White House to clarify last week's surprise tariff on bullion bars. We are a rounding error away from an all-time high, less than 0.01%. So if we open where we are this morning, which is little change for the S&P and NASDAQ, we will get to those all-time highs. The bullishness is evident. Citi upgrading their price target for the year end to 6,600. Bank of America saying their latest fund manager survey shows us the most bullish since February. Meanwhile, for this bond market, it was yields higher this week. We take a breather this morning, lower by 2.5 basis points for your 10-year. We'll get CPI tomorrow. Meanwhile, gold futures at lows of the session down 2% after rallying on Friday after a surprise 39% tariff from gold coming from Switzerland. The White House says that they will clarify that. We are still waiting for that clarification. Let's, in the meantime, get you some stocks to watch. With that is Valerie. Good morning, Val.
Good morning. Let's start with Nvidia and AMD. After they have agreed to pay 15% of their China revenues for those export licenses, we are seeing both of them in the red in pre-market trade. Nvidia down around 1%, AMD just down right over 2%. Now, Danny, there can be argued that there's good things about this agreement because it does definitely sound like they are going to get those export licenses. Nvidia's was actually approved on Friday. AMD is still waiting for the approval for theirs. Let's stay in the AI space and move over to C3 AI. This is a software company that deals with AI applications for businesses, giving some catastrophic guidance in its results. Its guidance for revenue came in a third less than the street estimated, and we're seeing that stock fall around nearly 30% in pre-market trade. Now, this company offers software to businesses that helps optimize anything from supply chains to inventory. So they are not seeing that kind of growth that's happening in the rest of AI. Lastly, let's end with lithium miners listed in the U.S. They are seeing a decent boost in pre-market trade. This is all down to China shutting down one of CATL's biggest lithium mines in the province of Jiangxi. This is important, Danny, because this is maybe the beginning signs that China is beginning to clamp down on overcapacity in some key industries. They're starting with lithium. Danny.
Valerie, thank you very much for that. Now, investors are also gearing up for another busy week of economic data. There's U.S. CPI tomorrow, PPI and jobless claims on Thursday, finally U.S. retail sales and the University of Michigan sentiment survey to close out the week on Friday. Saidel-Baker of ITR weighing in and writing, quote, inflation will likely rebound in the second half of 2025 and into next year. Our analysis suggests it will take between 9 to 18 months for tariff-related inflation to become evident in the data, as you saw just there. Lauren is in the studio with us. Lauren, great to see you this morning. Thank you for joining.
Thank you.
So it will take some time, to your point. You see it for inflation to show up. So what are you expecting tomorrow? How much tariff-driven inflation might seep through in the numbers?
So tariff-driven inflation is the key there. Everyone is looking for the impact of tariffs, and I just don't think we're seeing it yet. That's not to say we aren't seeing building inflationary pressures. Those are just for non-tariff related reasons. We have a lot of fundamental drivers that are just now starting to really flow through the data. We saw this in last month's report, kind of those early warning signs that pressures are building. So I think it's going to be important to differentiate, and critically important for the Fed to differentiate, what is a one-time step up in prices due to tariffs, and what are these more lingering kind of fundamental pressures that aren't going away anytime soon.
It's such an interesting point, because the Fed governors who have called for cuts, both Waller and Bowman, have been talking about the idea that tariffs are a one-off. So what you're saying is, even if tariffs are a one-off boost to inflation, something else is still going on that maybe should keep the Fed more restrictive at this point?
Yes, we absolutely see that at ITR. The fundamental pressures, I mean, there are things that are baked into the numbers for a year or even close to 2 years at this point. In addition to the typical monetary and kind of fiscal policy that we've seen, we also just have those persistent wage pressures. Because they have come down, I think a lot of businesses and market watchers think that they're done. We don't have to worry about that anymore. We are seeing building energy prices, electricity costs being much higher now. So many of those kind of individual threads that we could try to pull through to see each one in concert, all of those pressures are now kind of coming together at this moment in time to build some inflation, to build some pricing pressure.
What does that mean, what the bar is for the labor market to look weak enough to force a cut, even if you have some of that building in the background?
That's the real question. These last jobs numbers clearly were softer, but by our analysis on a not seasonally adjusted basis, they were soft, yes, but at the low end of our normal range. This was not the bottom falling out from the labor market. And in terms of balance, we really do still see some balance between the number of unemployed workers and the number of job openings. Now, both of those numbers are a little bit lower now, so I think of it like a scale that can be in balance, whether there is a lot of weight on both sides or very little weight on both sides. We can still be in balance. It's just in one of those cases, it's a little easier to knock out of balance in the future.
Well, there are some arguments starting to arise that the reason that there are fewer jobs being created is because there are just fewer workers here. And if you cut, that doesn't help all of a sudden create more workers in the U.S. How do you see the drivers of this labor market and some of the weaker data that we've been getting? How much of it is about supply versus demand?
I think that's a very real impact that we're going to see, especially later this year. We expect to see negative net immigration this year. And so taking those workers out of the job market, maybe on median doesn't make a big difference, but in certain sectors, certain skill sets, that's going to be a real detriment to labor availability.
You also can't talk about what the Fed does, especially next year, without thinking about who heads up the Fed. Wall Street Journal had reporting over the weekend that you might get someone like Summerlin or Bullard, two more traditional type picks. It shows that maybe we are getting Bessent to run this process. The Kevin's still under consideration, Waller potentially too. Just looking at these names of candidates, Lauren, how much does it change your outlook for what the Fed does in 2026?
I think it's no surprise that we will see a more dovish individual in that Fed chair. So most of these picks, I mean, they're not so far out of kind of the range of consensus. No one is really an oddball from left field. So we'll be watching closely, but they're smart heads. Again, it's just a more dovish tone that will be taking hold.
A more dovish tone, but we were speaking with Neil Dutta on Friday, who said that there's a risk that if Chair Powell stays on the governorship, he acts almost as a shadow Fed chair and tries to kind of navigate the divergence there. If anything, it just shows a more split and more disagreement within FOMC members? Maybe that's something that looks more akin to the BOE. How would that shape policy if it is a Fed that is more divided and has less of the consensus building that we've come to expect from the FOMC?
We've seen this in the past couple of meetings. Already almost like two camps are emerging within the Fed, both in terms of the dot plot and then with two dissents in the most recent decision. So I think there's some amount of dissent amongst the ranks already. However, you have to consider that when there is dissent, even just two dissenters, still the consensus, the vast majority of those individuals are still aligned.
We should probably know that this is tomorrow going to be the first CPI report without a chief over at the BLS. I'm sure Trump will have something to say on Truth Social of what it is, maybe depending on how the numbers are. When you look at the economic data, a lot has been said about fewer responses, maybe less reliability there. If you look at a more political appointment to the BLS, how would you approach the data coming in? Do you still use it? Do you look for more alternative sources? Maybe you already are at this moment. How are you thinking about it?
So with regards to who is in charge, the commissioner of the BLS, that is not someone who has their hands on the data. So I would not expect either the previous commissioner or any future commissioners to really be pushing on the scale one way or another. What I'm actually more concerned about, as you mentioned, the lower response rates, but we've also just seen more imputed data points. Over a third of CPI data points are now being imputed in at least the most recent month of data. So we're looking for that divergence. It won't happen at first, right? Anytime we get kind of a drift away, we would expect that divergence to widen over time. If anything, I think the risk is to understating CPI, just given where the structural factors are. But at the end of the day, all we can do is look for additional data sources to either refute or deny or collaborate what we see coming out of the CPI, but we'll be watching other data sets closely as well.
Lauren, we're going to have to leave it there. Thank you so much for joining. This was fantastic, as always. That is Lauren Saidel-Baker of ITR Economics. Coming up on the show, an unprecedented arrangement. Shares of Nvidia and AMD lower in the pre-market trade after an agreement with the U.S. government that I think few saw coming. We're going to have more on that next, coming up on your brief. Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Let's now get you the latest on trade, where President Trump is urging China to quadruple its purchases of U.S. soybeans. It comes just a day before the U.S.-China trade truce is expiring. For more, we're joined by Bloomberg's Brendan Murray, who leads our global trade coverage for us. So, Brendan, a day to go, how are things looking between the U.S. and China negotiations?
Well, it sounds like President Trump is trying to nudge his counterpart, Xi Jinping, to engage. He said, "Thank you very much, President Xi." And here we are, less than 24 hours before that deadline, and we still don't see any movement toward a truce, at least publicly. So we'll have to see how things play out in Washington today. But those tariffs that the U.S. and China had on each other are going to snap back if nothing happens between now and midnight Washington time tonight.
They're going to snap back. And again, the latest call here is for soybean purchases. Brendan, do we understand what some of the sticking points continue to be between the two countries?
Well, they continue to be, and have been for weeks now, the supply of magnets that China controls and the supply of advanced chips that the U.S. controls. So we're seeing some horse trading going on. Commerce Secretary Lutnick has called it as such, and so I think we're seeing both sides trying to position themselves to give a little in that area, but not give too much. And so those are the main things that are bogging down the two sides from reaching any sort of agreement. But we could see something before the end of today. And soybeans is sort of that classic American export that China has traditionally bought a lot of, but has been going to South America more recently. So and the price of soybeans in the U.S. has been pretty flat for a while. So President Trump is trying to offer China a way to kickstart those negotiations while also sort of juicing the soybean market for American farmers who are sitting there looking at their soybean fields going, we're not going to make a whole lot of money this year unless prices go higher.
Brendan, we're going to catch up with one of our tech analysts out of Bloomberg Intelligence shortly about AMD and Nvidia agreeing to give the U.S. government 15% of their sales revenue to China on AI chips. But can we just hang for a minute on the politics of this, Brendan? Some people look at this and say, OK, we're tariffing exports now. How unusual is this move from the government, from these companies?
Yeah, it's pretty unusual, and the China hawks in and outside of the administration in Washington are going to criticize this as you're basically selling what used to be national security leverage in the way of export controls. President Trump might turn that around and say, look, we need to find a way to deal with China, and why not charge the companies the 15%, and maybe they'll pass that on to Chinese buyers the same way that the president is charging American importers tariffs that he says will be paid ultimately by foreign trading partners.
All right, Brendan, thank you very much. That is Bloomberg's Brendan Murray. And let's get more on that story. And our Bloomberg Intelligence tech analyst Charles Shum joins us now for more on this of AMD and Nvidia giving up 15% of their AI revenue from China chip sales to the U.S. government. Charles, how does this change the business model and where AMD and Nvidia go from here?
All right. This is actually a very new movement because it actually showcases that the revenue sharing would be actually the part of a new export policy from the Trump administration. So going forward, from the investor perspective, actually the policy risk will be actually a line in their model. They have to actually count how many percentage profits that has to be shared with the government. And also, this actually, the policy risk will be actually a part of the competition games that for both the buyer and also seller have to consider. Because in the near future, now it's actually possibly 15%, but who knows when will that goes to 25% or even more. So that's something that I think from the investor perspective, they have to consider about this.
Charles, just while we're talking about corporate America, tech companies under pressure, there's the Intel CEO, too, the Journal reporting that he's going to be visiting the White House. What is the likelihood that Lip-Bu Tan can stay on? Is there any wiggle room for him at this moment in negotiating with this White House?
Yeah, that's a very good question. I think that's a very big question that the CEO has to answer. It is that whether Intel will continue to maintain its big investment plan in U.S. chip making capability. In the previous CEO era, he actually has mentioned that Intel will actually invest about $100 billion in the U.S. chip making capacity over 5 years. But since the new CEO comes on board, he never mentioned that. Actually, in the latest, in the recent the earnings call, he just mentioned that he will actually will focus on bringing the Intel back to the profit-making path, and he will very conscious on all the money he spent. So that he doesn't give a very clear answer on whether the Intel will still commit to the U.S. chip making expansion. So that's actually something that I think the Trump administration, who's actually pushing for more advanced chip capability in U.S., will really want to the CEO to answer this question clearly and also, yeah.
All right, Charles, thank you very much for those updates. That is Charles Shum of Bloomberg Intelligence. Now, meanwhile, gold futures are falling as traders await further clarification from the White House over tariff policy, down 2.1% this morning after a rally on Friday over those surprise tariffs from the Customs and Border Patrol that they were charging on gold from Switzerland. Bloomberg's Jack Ryan joins us for more. Jack, what sort of clarification might we get from the White House today?
Well, that's what everyone's watching for. We're not sure, is it going to come today or later in this week? They said on Friday that they would be issuing an executive order to address, as they said, misinformation in the gold market. And that was basically coming after on Thursday and through Friday, we had this quite dramatic Customs and Border Protection Agency ruling, which essentially said that 100-ounce bars or kilo bars of gold, which are, particularly kilo bars, the most common type that's traded in the United States, would be subject to tariffs. And that came as a real shock to the market. And so the White House was quick to kind of address that, but then no one knows exactly what they're going to say.
So what are refiners doing in the meantime, Jack? Is this a market that's frozen?
Exactly. I mean, I don't think there's any gold on the way to the United States now, because from speaking to the refiners myself, they're terrified by this. And essentially, they don't want to take the risk of taking a potentially 39% tariff on gold bars that they're exporting to the United States, because the margins in this industry are super slim. They can't wear 39%. So they are really worried about this and essentially not taking any risks. That's the word I'm getting from the refiners.
If this continues on, we don't get some sort of clarification, or maybe even if we do, just the disruption itself, Jack, how does that change the global gold trade? What happens if we do get something that looks like a 39% tariff?
So I guess the strange thing is that this isn't really a market for goods. It's really an investment asset. So no one, I think, would really be willing to pay a 39% premium on a bar of gold, any more than they'd want to pay a 39% premium on an investment security above the market price. And so really that would make it impossible to ship gold to the United States. Because these bars, kilo bars, 100 ounce, they underpin the biggest gold futures market in the world in New York. There's a lot of people that I've spoken to, people in the market have said this market actually wouldn't function if you had tariffs on gold in this way. Now, the administration has in the past kind of expressed the principle that they don't want to tariff gold. So I think for a lot of people, the expectation is that this has been maybe a misunderstanding and perhaps this will be rolled back. But we still don't know yet, and there's a lot of fear about it.
All right, Jack, thank you very much for that update. We'll see if we get any clarification from the White House in the next coming days. That is Bloomberg's Jack Ryan. You can see there gold in the meantime down 2.2% after its rally on Friday that saw U.S. gold and international move further apart. For this market, it is little changed for the S&P to slightly higher. We are going to hit an all-time high, though, if we close at the level it's currently trading at. The bulls are emerging. Citi upgrading their year-end target to 6,600. Meanwhile, Bank of America's latest fund manager survey says that it is the most bullish investor base since February. Coming up, it's a busy week of data. It'll kick off with inflation in America tomorrow. We'll lay out the market moving events for your trading diary coming up next. You are watching Bloomberg Brief. Let's get you set up for your trading week this week. And it is a big piece of data coming out tomorrow. It is your U.S. CPI out on Tuesday. Expectation is for 3% and 2.8% for core. That will be followed by PPI and jobless claims on Thursday. Finally, we're going to be rounding out the week. We'll get retail sales and the University of Michigan sentiment survey. Those both come out on Friday. All right, some of the individual movers this morning, both Nvidia and AMD falling in the pre-market, an unprecedented deal by any stretch of the imagination. The two companies agreeing to pay 15% of their Chinese advanced AI chip sales revenue to the U.S. Intel, those shares are up 1.6%. The Wall Street Journal reporting that Intel CEO Lip Bhutan will visit the White House today. He'd come under fire from Trump last week, with Trump saying that he was conflicted, should resign. Meanwhile, lithium-linked stocks off to the races this morning. 10% for Lithium Americas Corporation. They are surging after CATL in China halted their operations at one of the world's largest lithium mines. There are questions whether China is moving back on some of its overcapacity policies. Meanwhile, your bond market this morning, we are looking at a rally. Yields are lower by nearly 3 basis points for your 10-year yield. We moved higher by 6.6 basis points last week. Some soft auctions abound. Again, big data pieces coming up that could yet again shake up this bond market. That is it now for your Bloomberg Brief. Surveillance will take things from here on Bloomberg.